there's conference rooms in Japan right now where people are freaking out and being like, how do we unwind our positions?
Malware is a non-technical look at the tech news of the week.
This is a podcast where we learn together about everything from crypto to AI to whatever comes next in tech. I'm Natasha Hoskins.
I'm Dina Burke.
And this is Boys Club.
Wait, is it just Boys Club?
It's just Boys Club.
The Boys Club podcast?
No. Just Boys Club.
On the podcast today, we have Jonathan Wu, who is an investor at Asylum Ventures, which is a $55 million early stage fund in New York. And Jonathan was also the main character of Twitter on Monday when he dropped a very viral thread about carry trades and the Japanese yen that seemed to maybe somewhat kind of explain the market meltdown that we lived through earlier this week. So we're going to have Jonathan graciously and hopefully patiently explain the thread to us and his thinking. So welcome to the show, first of all.
Thank you. Glad to be here.
We're excited to have you. Okay, so just to do some level setting for folks, this is a headline that hit earlier this week on Monday. Why Ethereum price is down today, ? A 22% drop triggers massive market liquidations. I read somewhere that they were in the $billion ballpark. And of course, that's just the crypto market. That's not to speak to the traditional market at all, which also had, I think, one of the worst days in recent history. So you did a thread on the Japanese yen and carry trades. I don't know. Talk us through it. Tell us what's going on here.
Yeah, man. I mean, the reason why I wrote the thread was because I myself was a little bit confused why a very, very small interest rate hike by the Bank of Japan would like crash all assets. Like equities were down bad, crypto was down horrible. And I think that was a question everyone was wondering about because like if you think about the United States, we've had like much more significant interest rate movement, historically high interest rate hikes in the 2022 to 2023 period. So I was like, okay, what is going on with Japan that like a tiny minuscule 25 basis points, so 0.25% hike would like cause all this calamity? And, at the heart of it is something called the carry trade. And what the carry trade is like basically a form of arbitrage where you like borrow money for some rate. So let's call it 0%. It's not exactly 0%, but let's say you could borrow money for 0%. So let's say I, went to you, Natasha, and I was like, could I borrow $1? And you were like, sure, here's $1. And I'm like, cool, when can I pay you back? You're like, I don't know, like in a year. And I'm like, great, how much will I owe you? And you're like, just the same $1, like no interest. I'm like, that's a pretty good deal for me because as long as I make more than $1 anywhere else, like it's basically free money, right? Like I'm pretty I'm pretty much like locking in that interest rate spread. And so the carry trade has been going on, I mean, just anytime there's a spread in interest rates, but in Japan for like a really long time. So Japan has had like close to zero interest rates since like 1999. And the reason why Japan has had close to zero interest rates since 1999 is because they had like one of the worst asset bubble collapses ever in the 1980s. So it's funny, like during the rebuilding in World War II, after World War II, Japan became a global economic superpower. They think about famous companies like Sony and the Walkman, and Japan led in microchips and was like a high tech at one point was the number 2 economy in the world. Kids in the United States and people were learning Japanese. Japanese culture started to seep into the United States, right? Like sushi restaurants became really popular. And in the 1980s, for a variety of reasons that honestly I'm not an expert on and probably not worth getting into, like they had a massive asset bubble collapse. And when you have this huge collapse in asset values, banks oftentimes get hurt really badly. Their balance sheets get hurt very badly. And it's much harder to create capital. Like credit and capital formation becomes a lot harder after that. And so in an attempt to like stimulate the economy, they tried a bunch of traditional measures. And in 1999, the Bank of Japan, their central bank, the Japanese central bank, was like, okay, we're going to make money free. And so I think like the first important concept to note here is that an interest rate is basically just the price of money. And when like it's hard to think about, it's like very counterintuitive because like money is the thing that things are priced on, right? But like money also has a price, which is how expensive it is to borrow it. And when you borrow money, you're actually like creating money. So if I were to borrow $1 from you, Natasha, like actually we're creating a new dollar, a dollar that never existed. Because basically like I now have $1 and I owe you $1, but that dollar didn't really exist before. And that's how banks work, and that's how credit formation works, and that's actually how money gets like quote unquote printed. It's not actually a printer. It's
Wow,
like
I feel like something just clicked for me that has never clicked for me before.
No, that's huge. I think people don't get that money printing is just borrowing. Borrowing is the creation. Of money. Yeah.
Okay. Great. I'm really tracking.
Okay, that's awesome. It literally took me like, I don't know, forever. Like it was like last year when I figured this out, because that's not the way they teach it to you in school.
Yeah.
And that's not the way we talk about it in common parlance. We're like money printer go burr. So we're like, oh, someone literally just prints more dollars. But actually, like money gets formed when you borrow. So since 1999, interest rates have been close to zero in Japan, and the reason why cheap money is good and it spurs economic activity is because if it's really easy to borrow and it's cheap to borrow, well then I can go invest, right? I can go build a new factory because it's like free to build. Like if you gave me $100 to build a factory, as long as that factory makes more than zero return, like I've made money. And so that's how an economy gets stimulated with low interest rates.
Can I ask a question here, which is part of the story that I'm really fully not understanding is, so you say that they didn't raise interest rates since 1999, which seems like an extraordinarily long time. When I think about the U.S. economy, we're moving rates around all the time, even after, I mean, when there are significant market crashes, sure, things will get lowered, but then there's like a easing in that we do. And I'm just wondering, like, how is it possible that they kept it at?
No, there has been some movement. And there were other periods of like bubbly carry trades, like in the early 2000s. After the global financial crisis. And so like there have been other times where the interest rate moved. But generally, I would say they've had a very dovish monetary policy. In other words, like just monetary easing, quantitative easing, right? Just making sure that capital is cheap. It's really easy to form credit. And the reason for this is, and now it's worth talking about the relationship between interest rates and inflation. This is also extraordinarily counterintuitive. But like, let's talk about inflation and deflation. So inflation just means the price of things is going up, and deflation means the price of things is going down. And it's worth talking about like how different actors act when these things happen. So let's talk about like the economy, like the GDP. GDP is functionally the sum of all spending. So more spending there is, more GDP. So when we say growth, like GDP is going up, that means like people are just spending more money. Like in aggregate, everyone's spending more money. And so like, let's talk about inflation and deflation as it relates to spending. In inflationary times, like the prices are going to go up, right? And you expect inflation to happen. Like what is the behavior that you would expect like a consumer to take? Like let's say you were going to buy a MacBook today for $1,000. And tomorrow it's going to be like $1,200 because of inflation. Like, what would you do?
You would buy it when it was cheaper.
Yeah, you'd buy it today. You'd be like, it's going to go up by $200 tomorrow, so I'm going to buy it today. So inflation is kind of self-reinforcing, where it's just like, well, if you expect the price to go up, you buy it, which increases demand, which might make it go up further, right? So there are these runaway effects. Now let's like flip the equation on its head. Like with deflationary expectations, like if I think the price of things is going to go down tomorrow, then I'm not going to spend. I'm going to keep my money in my pocket. So for a very anemic economy, which like needs growth, needs spending, right? Mm-hmm. If consumers are scared to spend because they're like, basically the price is going to go down tomorrow, well, like that's very self-reinforcing.
Yeah.
And so in order to fight that, you basically want to drive inflation. That's why these central banks want a target positive amount of inflation, because inflation encourages spending, which encourages economic growth and continuity.
Okay.
If people don't spend money, like we're basically all hosed, like, you know, because if I don't spend money, then the retailer doesn't get money, and then Apple doesn't get money, and then Apple can't pay its employees, and it's like a very negative doom cycle. So what happened after the asset bubble in Japan popped is like people were scared and capital formation was hard and they didn't want to spend money. And so the way to get inflation, one of the ways to get inflation, is to inject more money into the system. Because if there's more money chasing the same number of goods, prices have to go up, right? And
Yeah.
that's why after COVID, inflation was so insane because the government like helicopter dropped like trillions of dollars on everyone. And so it's more money chasing, and at that time, a smaller number of goods because supply chains were really hurt. So like people weren't making as many things and there was way more money chasing them. And so we saw like 9-10% like crazy inflation numbers, right? It's like your rent was going to infinity. Like, you know, the cost of like consumer goods was infinity. Rolexes were infinity. Like, you know, luxury cars, everything went up. Okay, so to go back, right? Like the way to get inflation is to reduce rates, and that's the way to fight deflation. And so for an anemic, slow-growing economy like Japan, which has all kinds of issues, lots of old people, not enough innovation, no immigration, right? They needed to do this for a really long time, and that's why they were stuck close to zero interest rate, and why carry trades started to open up when the U.S. started raising rates, because we were close to zero rate or very, very low rate for a long time too. You might have heard of like the zero interest rate policy times, when like startups were worth infinity, and this was also the time when like everything, you know, assets were worth infinity, like consumer goods were going up in price. That's the reason why this spread opened between the United States and Japan, because we were both low. And then the U.S. was like, whoa, we have all these inflation issues now. To fight inflation, we need to raise rates. We need to raise the cost of capital, reduce the money supply. And so then we raised. Japan was like, we're not ready for that yet. Like our economy still sucks, and inflation's still not a problem, because like we still need, you know, we still need to spur more inflation. Like people are still scared to spend money. So this spread, that's the carry trade. That's what opened up the opportunity.
Okay. I think I'm tracking. Okay, so then basically what you're saying is then all these traders came in and started to execute on this idea of a carry trade. Can you talk a little bit more about that?
And also, are they trading between, are they like just Forex traders going between USD and the yen, or are they taking the yen and buying other assets with the yen?
Yes, the latter. So they're not trading. I mean, there is Forex trading, of course, happening all the time. Directionality on whether you think the yen is going to go up, the USD is going to go up. But the carry trade specifically is borrowing in yen. So if you go to Japan and you borrow money in Japan, they're like, here's free money. Here's like, I'm not going to make you pay an interest rate on it, right? But then you could take it to the United States, where we had raised rates significantly, and you could buy U.S. Treasuries for like 4 or 5%. And so you're like, okay, amazing, like free money. Like I owe 0%. And I make 5%, so I make 5% on my money. Like I'm a genius. So that is what the carry trade is.
Okay. And bad news starts to come when that rate is no longer, when the rate goes up.
When the rate goes up. Now, what's weird about it, and what was weird to me, and should be weird to everyone, is like, okay, but the spread let's call it 5%, right? It wasn't exactly, but let's just say for all intents and purposes, it was like you borrowed for 0 and you invested in something that gave you 5. Well, the BOJ was like, okay, we're raising the rate from 0 to 0.25. It doesn't seem like a big deal, right? Like it's like, okay, I was making 5, now I'm making 4.75. I don't know. Why is that like causing the third highest volatility day in the last 20 years outside of like 2008 and like COVID? Like, why did it ruin everything? Okay, this is the counterintuition that like I think that's why the thread went viral, and like is like this is the complexity of macroeconomics. When the interest rate goes up at all, right? First of all, I think it's very shocking because you mentioned this before, Dina. It's like it's not as if the Bank of Japan wasn't adjusting interest rates over the last 25 years, but for the most part, they weren't really indicating that they were going to ever go raise rates a ton.
Okay.
And so the BOJ did two things. They raised rates, but they also were like, yo, we're going to do everything it takes to like beat inflation now. They started talking like Jay Powell talks in the United States, which is like, we're going to beat inflation. And like, it's worth noting that Japan had actually returned to inflation because the Japanese economy had been doing better. And so they were like exceeding their inflation target. Like Japan finally saw the thing that they were trying to get after so many years. So much so that they were like, maybe we don't need zero rate anymore. Maybe we can raise rates a little and we can fight inflation. That's the reason why it went up by 0.25%. But like, that's very terrifying for a lot of reasons we'll get into. But it's like, it's not just the quantum of the interest rate increase, it's the directionality and the intent. It's like, hey, we're going to raise, but we might keep going. So why then is the spread is narrowed just a little? Why did everything unwind? Well, now we have to talk back. We have to go back to money, and now we have to go back to a new concept, like the yen to U.S. dollar price, right? So the yen had been falling in value against the U.S. dollar. So the USD JPY price, so in other words, how many yen can one US dollar get you, had gone to a high of like 162. That means for every dollar of American dollars, you could get 162 yen. And it had gone up to 162 from like 100 a couple years ago. Like the yen has been losing value like all the time. So the Japanese consumer was getting hit by a couple things. Number one, inflation is really bad or getting worse. But the worst thing is that their global buying power was going down.
Okay.
So it used to be that like it only took 100 yen to buy $1 worth of stuff from the United States, but now it takes 162 yen. So imagine if your employer pays you like whatever, 100 yen a year. You know, you could buy $1 worth of U.S. goods, but like now they pay you 100 yen a year, and you're like, I can only buy like 60 cents worth of U.S. goods. And Japan, you have to remember, is a really resource poor country that has to import like everything, right?
Yeah.
Like they can't make anything. It's like a tiny island. So for the consumer, they're bearing max pain. They're like, I have no buying power in the global marketplace, and if I'm a manufacturer, I have to import machinery. Okay, well, the cost of the machinery keeps going up because the yen keeps getting weaker and weaker and weaker and weaker. And part of the reason why the yen is getting weaker is because the interest rate's so low, and so there's a lot of yen going out the door, and so there's more yen relative to dollars, right? Okay. And especially as U.S. interest rates went up, that restricts the U.S. dollar supply. Meanwhile, the yen supply is still really high. So then the yen keeps losing value against the dollar. Does that all make sense so far?
Yeah. The main thing I'm struck by is like, what a shitburger. Like everything happened at the same, everything came together just perfectly around like all of these different major macroeconomic trends for this specific moment.
I think what's crazy is like the economic machine is very complicated and all the parts all rely on each other.
Yeah.
And so it's like really hard to predict like what could break the system. Because like even just like a tiny interest rate rise, it's like a butterfly flaps its wings in Japan and ETH goes down 22%. Right? And like why does that happen? Well, it's because there's this ridiculously complex machine.
Yeah.
And also there's a bunch of like fiat degens who are looking for arbitrage and found it in the yen. And
for sure.
And so I think not to overstep that as well.
Yeah, I think the image that it keeps coming up for me is just like a really heavy machinery and all of the little components and little gears and everything are all working together and perfectly aligned, and then like a little piece of sand gets in there.
Correct.
And it's all
That's exactly basically what happened. So let's go back to the carry trade unwinding, right? Okay, so interest rates go up a little bit. Now what happens to currency when interest rates go up? Well, there's a direct effect of like if the interest rate for your currency goes up, you want to hold it. You're more incentivized to hold it because before they were paying you zero to hold it, but now the yield has gone up, right? We're familiar with this in crypto terms. Like imagine like if just like before I was holding yen and it wasn't doing shit for me, and now I'm holding yen, but at least it's paying me 25 basis points. So the incentive to hold yen goes up. So on the margin, more people should want to hold yen now. If more people want to hold yen and there's more demand for yen, then the price of the yen will go up, right? If you think of the yen as a commodity and stop thinking about it as money for a second, people are paying you more money to hold yen. So you're like, great, I'll hold more yen, I'll buy more yen, price of yen goes up. Okay, this is the part that is fucked for carry traders now. Because when the price of yen goes up, now as a carry trader, let's say I borrowed like, for round number's sake, 100 yen to borrow I borrowed 100 yen and then I converted it to $1 US worth of assets. So like I bought $1 of US treasuries. If the value of the yen goes up, right, then I owe more yen. I owe more yen. Like for every yen that I borrowed, I owe more in US dollar terms. Does that make sense?
Yeah, it does make sense. And all of a sudden, it's like you're upside down on it, right?
You're upside down. So I was going to make 5% over like a year with the carry trade, right? Because I was borrowing with 0 and I was getting 5%. But if the value of the yen goes up by just 5%,
right,
I'm wiped out for the year. Yeah. But the value of the yen hasn't gone up by 5%. It's gone up by like 15% or like 10 or something like that. And so like a bunch of the people who were like, great, like I'm making free money, are now all of a sudden underwater on their trade. And like badly. And by the way, if you were leveraging this trade, using borrowed money to execute this trade, you're like crazy underwater. And if you used a ton of leverage and you were a complete degenerate being like 5% free money, why wouldn't I just 20x leverage that and get 100% free money, right? That's like the degen logic. If I did that and I applied a bunch of leverage, then I'm getting liquidated. I'm a forced seller. Like I need to pay back these loans. And the way that I pay back these loans is I have to sell the assets that I borrowed to buy. So that's why there's this like sharp downward move, because in order to pay back all the yen that I owe because I'm underwater, I have to sell the assets. So that's why like equities are being fire sold, like crypto is being fire sold. All these leverage traders are just dumping everything. So that's the sharp move down that you saw.
Wow, so interesting. And you are so great at explaining things. Like just a very generous way of approaching
Gifted,
this, which I
for sure.
Yeah, really gifted, truly. If you weren't managing $55 million, I would say you should be a professor. What keeps coming up for me, Dina, is your tweet that I am choosing to believe that this is all a huge marketing campaign for industry season 3, because it's devastating and it's awful, but it's like an incredible story around all of these things that happen. Exactly what you said, like a butterfly flaps its wing in Japan and Williamsburg freaks the fuck out because ETH goes down 20% in a few hours. So anyway, it's really interesting to see how all of these things sort of work together and have a ripple effect. And I just really appreciate the way that you've approached this conversation.
Of course. I mean, like, it's so hard to figure out. It's so unintuitive. And it just strikes me that, like, one thing I've learned as an investor is if it's a no-brainer, you're definitely getting fucked in some way. If it's so obvious, like, if it's so obvious, right? If it's too good to be true, it is like, you know, that's what your parents might have told you. And, like, what I've learned as investors, like, that's 100% true.
Yeah, no such thing as a free lunch.
We like to think in first-order impacts. Like, oh, the worst thing that can happen is like the BOJ is going to raise rates by 25 basis points. Like, that's the worst thing that could happen, right? So how badly could I get fucked? That's the first order impact. But the second order and the third order impacts, there's all this other, like, you can't peer that deeply into the machine unless you're such a thoughtful person. And so, like, in general, if on the surface of the machine, you're like, oh my God, free money, like, you're missing something deep inside that machine.
Okay, just really quickly as we wrap up, where do we go from here? What's next? Like, what has happened? No crystal ball, I know.
I mean, I have no idea. I mean, I think the way that I'm thinking about this, and I'm not a macro investor, right? But we think about macro in terms of, you know, our liquid token allocation and when's the right time to, you know, have a good basis to enter. I think that the people who were leveraged to the tits got caught with their pants down, right? And they were forced sellers. Like, they got fucked. Like, they had to puke everything up, right? But there are other people who are also maybe leveraged, maybe taking some risk. And this week, I guarantee you, they were in a war room scrambling, being like, guys, we need to get liquidity. Like, those idiots are host, right? They're so fucked. But, like, if it goes further, we're next. And so we're seeing this kind of quiet period where, like, something big broke. But it seems like maybe we're okay.
Yeah.
But, like, there's conference rooms in Japan right now where people are freaking out and being like, how do we unwind our positions, right? There are people who are exposed to this trade who aren't, like, forced sellers, but their risk management is, all the alarms are going off. And they're like, how do we start unwinding? The BOJ had to say, like, hey, look, we're not gonna keep going because you guys all freaked out. So, like, we're not going to ruin the world economy. Like, you know, there were probably some very hurried phone calls that were made between countries, potentially just being like, okay, we need to maybe stabilize a little. But there's some folks here who are probably still in some pain. Now, to what degree? This is kind of like, it's a little bit like when, I forget which one came first, but like First Republic went down.
Yeah.
And then we were like, oh, that was bad, but they just had some like weird practices and maybe it's just one small regional bank. And then it was like, oh no, then SVB went down, right? Like, and it took some time. It took some time because like they tried their best. They tried to shore up liquidity, but the fear and uncertainty kept creeping in, and like then something else bad happens. And then, by the way, that was the extent of the damage. A couple more regional banks went down, but like the economy didn't. Like overall, it was resilient. So I think we're going to find out over the next couple of weeks, like, are there other shoes to drop? Like, I don't know. And I think what we're waiting for is for the Fed to do something. And I think what's scary to me about the Fed doing something is like, in order to prop up asset prices, they need to cut interest rates, right?
Right.
That's how we know that relationship works. But if they cut interest rates, the spread on Japanese yields and U.S. yields goes down again. It goes down more. And if the spread goes down more, then the people who are caught with their pants down or like about to be are going to be under more pressure. So if I'm one of those people who's exposed to this carry trade, I'm definitely scrambling right now because the Fed wants to cut like assets, the American stock market is like cut. Kamala Harris needs a cut in order to like be president. Like there's all these pressures to like cut. But if I'm a carry trader, like that's going to put me under more pressure. So I gotta scramble. So we're going to find out, like, is there going to be enough liquidity? Are they going to be able to save themselves, or is something else going to break?
Well, if you're a carry trader and you're listening to this podcast, you've made some mistakes along the way. But I think our recommendation would be...
If you're a carry trader and listening to this podcast, it makes sense that you're underwater.
Yeah.
All those things.
Someone is definitely listening to this being like, oh, yeah, wow, it wasn't
That's
free
what
money.
happened.
Wow. Oh, yeah.
Oh my gosh. Well, this was so enlightening and I really enjoyed it. And
too.
I thank you so much for your time and again, just like your generosity in approaching this conversation. And I hope this doesn't continue to happen, but as the story develops, you're going to be our frontline reporter.
Our correspondent.
Fantastic. I can't wait.
Great.
Thanks for having me.